So good morning. How are you doing today? G'day, mate. Today is April Fool's Day, April 1st. It's a Wednesday, oil inventory day, 2015. My name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. An ECN where you could trade Forex, energy, metals, indices, binaries. Pretty much anything your heart desires. Not credit default swaps, though. But more than enough for a healthy trader to be happy and satisfied and wealthy. Trip around the world. Pound is weak, euro is strong, Swissy is strong, yen is moderate, dollar is moderate, Aussie is weak, CAD is moderate, Kiwi is weak. The S&P 500 down 0.5%, NASDAQ down almost 1%, 10-year T-note flat, but at 1.93. Oy vey, that's just ridiculously low. Oil back down to 47, right? Down to 47, which is fine by me because it shouldn't have been at 52, in my humble opinion. So USD yen flat, Euro USD up 0.25%. European stock markets, FTSE up almost 1%, DAX up almost 1%, CAC over 1%. Sounds pretty good. I think we're going to have a good trading day. Trading and investing is risky, not appropriate for everyone. Past performance does not predict future results, so always stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Thank you for attending today's session live. I appreciate that. I enjoy the feedback and the camaraderie of doing this every day, 7:30 in the morning, New York time, London lunch. Also, if you're watching the recording, thank you for the feedback. Please give it a like, leave a comment. But like I suggested in the past, you should actually document what you learned today, what value you took from the video, as a way to manifest the learning experience from something where you just sit there and say, makes sense, and then you go and trade on your own and nothing makes sense, right? Document it, write it down. Imagine going to college and never taking notes in class. Good luck with that. So write down a comment. Not for me, not for Traders Way, not for other traders, but at least for yourself. Okay, make the learning experience real. All right, so let's take a look at some yens here. Now that it's a new fiscal year in Japan, we can worry less about year-end flows. So hopefully that is out of the way. And so maybe start looking to sell some yen, maybe? I'm open. Okay, what kind of market conditions do we have here? Is it trending? It doesn't seem to be trending anymore. So maybe, just maybe, it's reversing. Now, the first part of a reversal for a downtrend is to find some support that it can't break. Eventually, it's going to need to make a higher high. Well, in this time frame, we've broken the 21, the 55, and then triple topped at the 200. That sounds like consolidation to me. This is the pound versus the yen, which is fine. We're not expecting any possible reversal fundamentally until maybe 2 weeks from now. The World Economic Report from the IMF, and even that at best is a guess. So, but nonetheless, it's been trending down, right? Lots of little highs and lows, but you can kind of just look at it like this, right? Remember, we shorted up in here. So now what? Well, if you were going to sell again, this is clearly your sell zone. Okay? So it'd be very interesting if it did. See, how about this? If you're just a technician, like you don't look at anything else, everything is built into the price, I'm fine with that. That's what you're expecting. But it begs the question, what do you do if it does this? Well, you still have to be cautious because that's going to be a bearish 618 versus a bearish 382. So that's called fib wars. But the more it does it, all right, the better it's going to feel. Oh, yeah. Maybe. I'm not saying that it's going to do that, but I'm very open-minded to that. Okay? So one thing we can agree is this has been a downtrend, for sure. But it seems to be consolidating right in here, isn't it? And that we've been here 1 week, 2 weeks. This is the middle of our 3rd week, and we're still here. Right? So, yeah, again, I think these are going to be the key areas. Understood? Hey! Yup. Adam's working on his American accent. Yup, sure enough. Cool. Arigato! Hey, you're welcome. All right. So, kitty CAD. Are we ready to buy CAD? Yeah, these are difficult trades, man. Only because, you know, it's not bullish, but you want, or let's say it's not bullish, but I want to be a bull. So again, maybe another opportunity, trade binaries, either hedge or just kind of trade with minimal risk. So like one of the things that I often do if I'm trading without clear direction is I'll do like a 25-25 OCO if I'm scalping, or 100-100 swing without clear direction, that kind of thing. And a binary basically has that built in. Okay, so like very often I'll say, all right, I'm going to go long, but I'll put a limit here, I'll put a stop here, and whatever. All right, which is nice, but in the cash market, as you know, this thing could go down and then up. And if you were long, you took the loss, right? But you also missed out on the win, right? It's a double whammy. But obviously, as a binary, as long as you give it enough time, should be fine, right? So that's why you could do that. Okay. So anyways, I'm looking at this, and you know, I want it to go up, but you know, with commodity prices down, iron ore dropped below 50 about a half an hour ago. You know, just commodity plays are not that good. Canada is not Australia, so I do treat it differently, mostly because Canada's #1 trading partner by far is the United States, and the United States is doing good. Australia's #1 trading partner happens to be China, and they're not doing good. You understand the difference? Western Canada has the best potassium. Canada's potassium is a #1. Australian potassium is a #10. I killed myself. All right, Louflet. But, you know, I want to actively participate in maybe helping some of these things out, maybe. You know, you got to get in the game. But that's why maybe you know you're only risking this much, and then maybe you let it run. But you see why I'm not ecstatic yet, because it's not an uptrend until we break some of these levels here. The question is, am I confident enough to participate? So why it brings up a good point. The difficulty with binaries is you need a higher than a one-to-one ratio, risk-reward ratio to make money. Well, obviously you're making money. It's just harder because you can't let the winners run. But they're designed to hedge. That's the big, you know, that's the misconception that people get into. A lot of people turn to binary options because they're just degenerate gamblers, and it sounds like a quick way to make money. I made 80% return on my money in less than 2 minutes, right? Really? Well, that's stupid. But is it a useful tool to a skilled market technician that's speculative? Oh, yeah. And I might even argue it's a better thing to scalp with. Because, you know, I've been around a long time, and I've analyzed millions of trades from hundreds of all successful traders, right? They're all successful. If I'm analyzing them, why would I analyze a trader that can't make money? So I've analyzed, you know, over certainly 100 traders that are successful. And most of them I would never invest with. But if you break that down to a subcategory of scalpers, one of the things that I see is that someone might have, you know, I'm looking at a guy right now that's got probably, I haven't measured it yet, but it's a minimum 80%. It's probably more like 85% win rate. 85% of his trades are winners. He almost never loses. And he makes about, you know, 5 pips on average. And he's been doing this for years. Problem is, what I call the pain to gain ratio is, you know, how much do, let's say he's short, right? How far will price rise before he takes his 5 pips profit? And it could be like 25. So he's got a 5-to-1 pain to gain ratio, and that bothers me because one loser will take out 5 winners, right? A binary is not like that. What's the difference? Well, you're either going to lose 25 or you're going to make 20. The rest is the cost of doing business, right? The cost of, but if you're in the cash market and you did a 25-25 OCO, you've still got to cover your bid and any, you know, ECN commissions and stuff like that. So I'm just going to put it as a 25-25 just for the example. So it's a 1-to-1. But if you're scalping, in my humble opinion, that's probably better odds than most scalpers get because they walk away with 5 pips. Very rarely do they take 25 pips. You see what I mean? But their scalp might be only 5 pips profit when the binary expires, right? But they're going to get paid for all 25. So basically, you're getting paid to identify support and resistance and pull the trigger. If support and resistance holds, even a little bit, you're going to get paid 1-to-1. So, you know, I might argue that it's better for scalping. And then, of course, because of that built-in, you know, you never have to worry if you're extremely wrong. It's no difference than being a little bit wrong. So, as far as hedging and stuff, it's a great tool to have. Okay? But would I only trade binary options? No, that doesn't make sense to me. Right? That, yeah, just doesn't make sense to me that way. So it's like some people just say, well, fundamentals are useless. It's all technicals. Okay, that doesn't make any sense, but as long as you're successful and happy with what you're doing, that's okay. But it's nonsense to believe that. But if it works for you, that's cool, right? Like, whatever, dude. Um, someone that only trades binaries and is successful doing so, hey, all the power to you, bub. But I think if you could pull the trigger successfully on a binary over and over and over again, it just makes sense. Like almost our entire conversation yesterday was let your winners run. Well, that's the number one problem with binaries. You just never can let the winners run. But there are other things that will offset that. So it's just another tool in the toolbox. You got to use it right. You got to understand it, so on and so forth. Like I think my binaries tomorrow expire tomorrow, right? Got a couple of gold. Let's check up in on that. I don't have a gold chart on this. Really? Oh, I have it here. By the way, does it sound better, Zeal? Okay, good. All right, so where's the trade? Well, this is gold in the cash market. So to see where the trade is, oops, I got to throw down the binary. And I'll go out to an hourly chart. And we're still profitable. So there's the trades, and they expire tomorrow, I believe. Right? And again, if I'm in the cash market and price goes up here, I lose a ton of money. Relatively, I can only lose about like that much on gold, no matter how bad it gets. So whatever. So I don't have to worry about volatility. So we've been in, I think now 1 week, and I think it was an 8-day binary or 7 full days, however it worked out. I just didn't want it to close on the first of the month. Maybe I should have, huh? Because I would have closed for money. Booyah! How many people look at gold every day? Like it's important to them. Jimmer, Herman, stuff. Yep. So again, maybe binaries are a fun way to scalp gold or to hedge your position. Have you ever thought about that? So let's say you're long gold, you're probably, if you're purchasing gold, it's probably because you're long gold. So what if you use binaries just when gold was at resistance, you sold the binary as insurance? New York Community Bank. So you probably noticed we're on about a 382 Fibonacci retracement, the drop. I'm just looking at the binary here. They expire tomorrow. It's 1700. 1710. And what time of day is that? What's all right? So it's just 12. All right, yeah. So tomorrow, close of trading. Hopefully, pick up $500. Cool. All right, but again, if you're a bull, you're probably getting. Oh, it's a 50%. My apologies. I'll apologize. Yeah, if you're a bull, you're clearly going to be interested in that zone. Should still have this area marked up where I sold. It still looks like resistance to me as a bear. On the daily, just caught between a rock and a hard place, really, right? This is why I think unless you have, let's say a reason to be in physical gold, just gold is not the best thing to be trading. But, there's a lot of people that have interest in it, so. But, that doesn't look like a good trade to me. Does that look like a trend? I can buy and sell and buy and sell and buy and sell all year? No, it looks like we're consolidating near a bottom. A lot of industrial commodities and stuff have fallen. In fact, why don't we, do you guys track the CRB? Yeah? Yeah, the CRB is a index of commodity prices. Oil, it's gold, and various things. Let's see if it'll tell us what's in this one. You'll have to Google it. Oh, wait. Will it let me open this? No. No data available there. All right, so it's an index of commodities, right? And it's what you'd expect: gold and oil and silver and blah 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 blah. There's some wheat in there, and there, what everything. Let's go out to a different chart. And so the way that you use this, or can use this, is if commodity prices are falling. Yeah, this is a much easier one to see, right? If commodity prices are falling, the value of commodity currencies tend to fall with it, right? And so gold is in here as well. So I don't know, think about what gold's been doing, about what the Australian dollar's been doing. This is just the last 6 months. So what has the Australian dollar been doing for the last months? I'm sure if you overlap the two, I don't know if it'll let me, they'd be very similar. They'd be positively correlated, right? Seems to me the trend is down. This is 1 year of commodity prices. Okay. So, like for example, in the nearer term here, like in the last few hours, um, things like iron ore and stuff, I mean, have been falling, and that's just, well, that's going to drag things down with it. So if gold is if gold is consolidating in a market like this, then that's actually pretty positive news, right? Less bad is really good. But long story short, I'm selling in a falling market, right? So that's a CRB commodity index if you're going to do some research. I believe Euro USD is near midpoint psych level. I don't know if you're interested. Just heads up as this is loading. Whoa, hey now. There we go. Let's take a look at USD yen. We had a trade plan here yesterday. Can you figure out what it was? Let's see. I have it going up here at the 618, which was 19 and a half. Right? You see the orange line here? I marked it up 19 and a half. I had two buy zones. We did this yesterday. I explained that as a bull, I'm either going to buy here, and if that doesn't work, I'm going to buy here. Oh, come on now. How many people can confirm that they remember this clearly? Those are my two choices. Okay? What do you stink? It's a bad bottom, right? It's not a J-Lo, but I wouldn't call it a bad bottom. So there we go. Next part of this is maybe it breaks out of the channel. If I was a bear, what would I do? I would identify two levels of resistance and sell. I could consider the cycle level 120. I could consider this massive pivot point. I could consider the double top. I mean, I don't know, like one of them's got to be interesting. Now notice my channels seem to have held. I think that's nonsense. I think it's really just the top here. But so we have the monthly central pivot point, top of a channel, psychological level. If you're a bear, like why would you not be short? Where's the confusion, right? Now, of course, a bull would be thinking about maybe buying this. On the hourly chart, does it look perfect for a bull? Wah, wah, wah. No, it looks like resistance is going to hold. Now, of course, what you can't tell is despite all this, what if it does this? Then we do break and you continue buying. Right now, it just says be cautious. It's unlikely. Actually, what it's telling you, instead of personifying it, is that relative to the previous candles, price has not made a higher high in a very long time. Therefore, it's overbought. That's what it's actually saying. It says current candle higher high, nope. Previous candle higher high, nope. Previous candle to that higher high, nope. Previous candle to that higher high, nope. Previous candle to that higher high, oh yeah. So clearly we had all this upward movement in the oscillator. And then suddenly we're failing to make higher highs. Well, that's why it comes up, becomes overbought, and then starts pointing down. It's the opposite here, right? This made a lower low, this made a lower low, this made a lower low. It's all good. All of a sudden, no lower low, no lower low, higher high. Guess what happened? Down, 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 consolidate, consolidate, turn up. So that's all it's really telling you. It's not a personification of anything. It's really overbought, Wayne. No, it's just, I mean, the algorithm just says, look, it hasn't made a higher high in a long time relative to the previous candles. So that's just that. Now, it can stay up here for a long time in the scenario of traders buy the 382, they buy it at the psych level, and it continues up. This oscillator will just say, oh, look, new highs. And will not come down. Why won't it come down? Because it stopped making lower lows. That's all. Right? That's all the math is doing. Okay? So if you were very bullish on this, and you just like everything going on, in particular, the first day of the new fiscal year in Japan, then you might be extremely aggressive buying in here. You just want it at 20, and as far as you're concerned, by the non-farm payrolls is going to come out, and we're going to head to 25. Oh, you want to see the fib level stuff? I look at all kinds of things, so hang on. I'm constantly looking at fibs in a trendy market. Oh, so what were we looking at? That was USD yen. I can open up a bigger chart here. So one of the things I often do, what time frame is this? 15 minute. Okay, I like to fib. So as soon as you get a higher high, oops, hello, didn't mean to do that. Okay, fib retracement, right? 382.1618, we almost hit that. Then as soon as it makes another higher high, okay, you fib that, 50% predicts somewhere between the 1382 and 1618. So then I project that to be the pivot point. So on and so forth, right? Works on all time frames. But one of the other things I like to do, and that's why I have an EA do it, but you don't need an EA. It's just something I like to do. Is I like to have the EA measure yesterday's trading range. Now, it's not always good because it depends on what you call a day. But the EA is saying that this is yesterday's low, that this is yesterday's high, and that this zone in here is the 382, 50%, and 618 Fibonacci retracements. So if I was a bull in this case, because it closed high, I'd want to buy here. But to me, it's Captain Obvious. Like, really? So Yeah, it's there. I already know it's there. It's just sometimes helpful to have it. In particular, if you're on a small time frame. Okay. The price action should be fairly simple. And it's way, way, way easier, as I've always said, if you make the decision ahead of time whether you're a bull or a bear. The longer you deny that, let's say, decision-making process, the longer you deny yourself the success you're looking for. So you can fight on as long as you want. You can drag it out for years and years and years. But when you have an opinion, you'll know it'll be your guiding light. Okay? So I like the saying, you stand for something or you'll fall for anything. Well, if you don't know, if you don't have a logical opinion on whether the USD yen should go up or down, then you're just going to be chasing price your whole life with no clue of what's going on. And it's going to make it very difficult to buy low at support or sell high at resistance, because you'll be constantly doubting whether you're a bull or a bear. So you'll just always be late. Okay? So anyways, using some of these bolder lines, you could use, there's the top, there's the bottom. So you see it's not quite right, but that's just the algorithm looking at yesterday. If it were me drawing it instead of the EA, I might use that as my low and use that as my high. Okay? But see, that's why very often humans are better at this. But I would use that as a range. Okay? And then I would do that, right? But the funny thing is, we already discussed that earlier. We've already done it before this. It's already been done. All right? That's why it's good to have a bias, but because by the time other traders are talking about it, we've already made our money. We're already adding our second, third on there, right? So to clear this up, in fact, this time, let's take that indicator off. Fibbits, delete. Look at, I mean, we're already paid for this one. While other people are talking about it, we've already been paid. Now we're still at the top of the channel. Is that good for a bull? No. Have the bears, stood their ground? Absolutely, they've stood their ground. So something's going on there. So what do you do now? I would certainly move my stop to break even, and if it breaks, I'm going to get paid big time, because as far as I'm concerned, we're going to go up 1,000 pips. Isn't that nice? The question is, are we going to do that 1,000 pips in the next 2 months or in the next 8 months? I don't know. How would I be able to control that? Not my problem. My problem is move my stop to break even, go find another trade. Right? That's all I know about Lyle. Let's take a look at the dollar, the dog pound. Let's go to the dog pound. Bunch of dogs in cages here. Okay. Here's an old trade plan. Oh, cool. All right, so, what's the trend? What's going on? Right? 48.50? Yeah, seems fine to me. Yeah, it seems like a fine trade, Armin. Um, I'm short here at 51.50. There's my sell. Yee-hoo! So you're short 48.50. I'm short 51.50. Nice. Cool. So we'll see where that goes. Has anything really changed? Well, it's slowing down. I'm a little worried about these pivots and stuff. But maybe a good NFP on Friday, right? Well, see, that's the thing, Armin. You have less pips than I. It doesn't matter. It doesn't matter. It doesn't matter at all. I don't think of it that way. What I'm trying to show you on these, because we planned this trade like a week, maybe 2 weeks in advance. It was pretty funny. And then the message was, I want you guys to get paid. I want you guys to make huge profits. And the only way I can do that is teach you how to stay in your winners longer. So all I did was carry out the trade plan that we discussed 2 or 3 times as far as entry. And now as far as letting it run, I'm doing that too. So that's all. But you could have been in 9 trades since then too, right? I'm just trying to show you, like, how much work did I have to do today for that, right? I didn't have to do anything. You're like, oh, what did you do today? Oh, well, I rolled out of bed, opened my charts, made another 60 pips, and went back to bed. Right? That's the way to do it. So anyways, there's the piggy. Nothing really to worry about. Continue mission. Everything's fine. Aussies is in serious trouble again. And we know that nothing fundamentally has changed, that we're still getting nothing but bad news out of China. And commodity prices, as I just shown, are still tumbling. And what does Governor Stevens say the value of the Aussie dollar is? Well, he said when we were at 85 that it was worth 75. So he gave us 1,000 pips. Thank you, Governor Stevens. But so that's when it was at 85, right? But when it was at 95, he said it was only worth 85. So he gave us another 1,000 pips. Cool. So what price are we now? 75.82. So we're pretty close to that, the target level. Which is, I don't know if you want to trade it like you did the Swiss franc against the euro, right? I don't know. I don't think Australia is going to defend a floor. He just verbally says when it's at 85, it's like, nah, it's only worth 75. They've changed their tone a lot, and I've been reviewing their meeting minutes and their speeches. In fact, I've been chatting with a reporter at Bloomberg about this too, about, now what? And I think you're going to hear a lot less of the, Aussie dollar is still overvalued historically stuff. But who knows? I know several months ago, the head of commodity trading at JP Morgan said iron ore and coal prices are going to drop 40% in 2015 and another 40% in 2016. Well, iron ore and coal, those are the two largest exports that Australia has. So, you know, I don't know, over the course of this year, the RBA might have to readjust their policy and say it's only worth 65. Okay, past performance does not future results. But I'll tell you what, when he told me it was worth 85 and we're at 95, I sold it crazy, like every single day. And then when it was 85 and he said it was worth 75, that's all we did too. Sell, sell, sell. So. So if he says it's 65, you know, I'll tend to believe him. Now there was a frustration here when it got close to 85, from 95 to like 86. Then it went all the way back to 92. And then from 92, it dropped down to 75. Well, that was a bunch of frustration, but what happened was Governor Stevens was hedging, sort of verbally hedging, not even hedging, but here's the thing. He talked it down to 85 and then didn't follow it up further talk, right? And what was probably happening at the RBA is that they were still in discussions amongst, you know, their open market committee whether they should lower interest rates beyond the all-time low, because they were already at the all-time low. So, you know, they were in that psychological position, like, do we lower it even further? And lots of debate stuff, and so not clear direction once we got to 85, so it went back to 92, and then finally they gave clear direction again, and it went to 85, and then it got to 85, and then he said 75, and so, you know, maybe it's easier now. Maybe they do take it down. It maybe, you know, because like China is still sucking wind, isn't it? I mean, there's just nothing good going on, right? Oh, thank you on the ADP. So, you know, I don't know. There's some more input, right? More input, Stephanie. Could be interesting, but I wouldn't aggressively sell now that we're right at this key level, 75 and some change, right? There is a floor of some sort there. So you've probably been selling this hard and fast for a while now, but I would say take a break. Okay. Technically, it's just the same. Fundamentally, it's not the same. So ADP, buck 85. So a bad ADP. So a bad ADP, does that mean the Fed's going to raise interest rates? Oh, did I kill that chart permanently? Oh, dang it. Sorry. Talk to me, Goose. A disappointing ADP, another dumb prediction. ADP jobs report. Does that mean the Fed has to raise interest rates as soon as possible? Okay, so what does that mean for the dollar? It's the same reaction as the FOMC, guys. Okay, it's the same as the FOMC. Traders have incorrectly priced in a near-term rate increase, and they're learning that they're wrong. And I'm still flabbergasted how wrong these professionals are. But nonetheless, a miss on the jobs report all right, is going to tell a lot of market participants that they're going the wrong way fast. So you might want to do, you know, take some profit on some trades. So you know what? I don't know, for the sake of learning, I'll take my 350 pip profit. Sorry, I know it sucks, right? Okay? Sucks. Doesn't that feel disappointing? How many people feel like that's disappointing? That's how you should be as a trader. You're like, oh, dang it, really? I only got 350 pips on that? Shoot! Yeah, but that's what I'm saying, right? I just closed it for 350 pips. But what's really going on here? Because it's similar to the FOMC idea, there are just too many people too long dollar all at once. And they're doing it, I think, based on a mistake, that they think the Fed is imminently going to raise interest rates. They even thought they were going to raise interest rates this month, which is just stupid beyond belief, in my humble opinion. Yeah, like that's so humble, right? But look, no, honestly, I look at the facts, and there's nothing that suggests they would do anything, right? So, anyways, so FOMC came out, and whatever, people were wrong. So then they're like, June, it's going to be June, and if not June, September. Well, I'm thinking, it's, I don't know, October if I was aggressive. I'm thinking next year, to be honest, right? Nothing at all this year, but I could be wrong in that. So October, right? Something like that. Maybe the October meeting. But anyways, so the market's going to have to rebalance, right? So I don't know. So I'll take my 350. I did. It's done. 350 out. Fine. Now what? Am I still a bull or am I still a bull on the dollar, or have I become a bear on the dollar? I'm still a bull. So what's my job now? Sell high, just like I did before. Identify multiple levels of resistance. Where would I like to sell? And because it was a disappointing news for the market, I might not sell today. I might. Could be a rabbit, could be. But, I mean, this could be till next week, right? Do I want to load the boat right before non-farm payrolls? Well, it begs the question, if ADP was a miss, what's NFP going to be? And that's a game that a lot of market participants love to play. Now, historically, there's been no correlation between ADP and NFP, but more recently, in the last few years, because of market manipulation by the central bank, it seems to be very highly correlated. Yeah, Jenny, guys, I just did it. Yeah. Yeah, look, I know, I just did it. I opened it up and I showed you, and I said it before I did it. There must be a lag. So we're out. I took the money. It was 344 pips. Nothing nice about it, just a trade, right? So now what do? Well, I might, but probably won't sell here. I might take a shot up here. I might take a shot up here. I'm going to behave differently because, for example, let's say it goes here, and then I think it would probably do something like this, and then consolidate. If it comes up here, it's going to have to do this. So whatever. So, I'm just doing my job. What do you do now? Well, have I changed my strategy from bullish to bearish on the US dollar? No. I just understand that market participants were wrong and they need to rebalance. They're like, wow, I'm overweight on USD. You ever hear professionals on Bloomberg or CNBC when they're talking about their portfolios, whether it's, very rarely do you have currency traders on there, but, you get, the most common thing obviously are those that are holding stock. And they're like, Google's up 10% this quarter. We're overweight on this one, which means they're very bullish. But again, they might have covenants that state that they can't be more than 5% in a stock, let's say. And because price has gone up, they actually, might be 7% now in Google, and they'll have to get out. Well, in this case, a lot of traders may have been long dollar. They're long dollar because they feel the Fed's going to raise interest rates, which would create bullish dollar. I mean, I get it. The thing is, they're just wrong in the Fed stuff. And I think it might be because they get their analysis from CNBC and the Wall Street Journal, which is I think the worst part of this whole story. Like, how does one come up with the idea that the Fed's going to raise interest rates in April? How do you even get that? Because I look at the data, now there's nothing that suggests the Fed's going to raise interest rates. Not the median minutes, right? Not historic numbers, not inflationary numbers, not wage numbers, not confidence numbers, there's nothing. So how does one that's in charge of $1 billion fund come up with the opinion that the Fed was going to raise interest rates in April? I mean, how do you, give me one reason kind of thing. So but it's a great way to sell newspapers. So that, that's why you got to be on the clue train. CNBC doesn't care about you. Bloomberg doesn't care about you. They're media. They're just reporting. And these are interesting topics. They are the topics to be concerned about. They are topics to talk about. When will the Fed raise interest rates? Well, do your analysis. And when they do normalize, at what rate are they going to normalize? And how are they going to do it? Now, I've already told you, I think what they're going to do is change the discount rate, but change the Fed funds rate. That's going to be the first clue. I've already told you this months ago, and we haven't even done that yet. Now, how does Wayne McDonald come up with that opinion? Well, let's do a quick Fed. Quick Fed lesson. There's something called the Fed funds rate. What is the Fed funds rate? Let's call that interest rate. That's the Fed funds rate. Just for sake of argument, let's call it 0.25. What is the Fed funds rate? Don, be careful. The Commitment of Traders report is a Tuesday close. FOMC occurred on Wednesday. Even though you're reading it Friday. Just careful, okay? What is the Fed funds rate? Come on, guys. Fundamental Analysis 101. This is your first day in Fundies class, right? How about this? Type in a question mark if you want me to tell you. Good. Okay, Glenn says the cost of member banks to borrow funds overnight. From whom? There's a key distinction here that I'm drilling at. Okay. Wrong. Wyatt got, or Gakko's got it wrong too. The Fed funds rate is the lending rate that is used to borrow money overnight. All of that is correct. Okay, all of that's correct. Because what happens is you have required reserves that you must place into the Fed every single day. And it has to do with, let's say you had 10% of your reserves, which are checking deposits now, right? So let's say there's $1 million in checking deposits that various have put in your bank, right? So now you got your checking deposits. Wow, we should probably let's get jiggy with this one. How do I add a whiteboard? I know we don't have much time. I've been talking for an hour already. Hang on, let's whiteboard this if it'll let me. Okay. Let's see if it'll allow me. I'm a bit slow in this one. All right, so let's try that. Oh, this is going to be really slow. I should probably just do this in Excel. All right, so you have over here. Wow, this is redonkulously slow. Yeah, hang on. We're not going to do the whiteboard. Desktop. Let's do the different way. Template. Oh, blank. All right, let's try it this way. All right, we need a balance sheet first and foremost. Okay, balance sheet. On the left, you have assets. On the right, you have liabilities. Okay, you have $1 million in deposits. Why is the cash in the drawers a liability to a bank? Yeah, because customers can withdraw it. You owe your customers the $1 million. How does a bank make money? It makes loans to businesses and people, right? So one way you can look at it is they're short on cash, but they're long-term long on their loans, right? They owe you on demand, right? They're basically paying your interest every single day, but they're making 30-year loans on mortgages. So they're short cash and they're long the loans, right? So anyways, now the Fed comes in and says you have to have reserves. You have required reserves, which is the RRR, the reserve requirement ratio, which is how much of the $1 million do you have to keep in? Okay? And that's what goes into the Fed. So currently in the United States of America, that's 10%. So you have to have 100K at the Fed. Then you have excess reserves, which is, anything that you haven't loaned out. Because the other asset now, because now this is an asset because it's money parked at the Fed. Okay? Now, you also have some loans, right? Now, in a perfect world, if you're the bank manager now, think like a bank manager. How much in loans would you like to have in your portfolio? Up to 900K, right? But what happens now, well, let me ask you, if you make a 30-year loan like a mortgage, you have what happens if you have $900,000? Now you got your 900K, now you're in balance, that's why it's a balance sheet. You have 900K in loans. Okay, are your loans liquid? Do they convert in cash instantly? No. So what if someone comes in and says, I would like to withdraw $100,000 so I can buy Wayne's used Mercedes. All right, it's gone. So now you have 900,000 here. What's wrong? This drops to 90. You don't have enough money. But do you want to dump some of your bonds? Or no, not bonds in this case, mortgages? Do you want to dump these? Heck no! Because you're paying your deposits, let's say what? Let's be generous, 1%. And you're lending it out now for 5%. And they're good loans because you did your due diligence. They're high credit people, right? Look at the money you're making. And you're not even doing it with your own cash. You get it? So you should have some excess reserves and stuff, right? That's why you shouldn't, being fully leveraged out here at 900K, you should probably, let's say, maybe as a bank manager, you say, we're not going to keep more than 8,000 on the books as loans, and we're going to keep 100,000 in excess reserves, because if someone makes a withdrawal, we can still cover the reserve requirement without having to sell some of our assets, because this is how we make our money. We don't want to sell assets. But let's say overnight there's a slight difference between how much you have to have parked at the Fed because of a withdrawal. And you're in good performing, profitable assets, but you're just kind of a little short on reserves. What do? You go to another bank. And you say, hey, JP Morgan, we're a little short on our reserves, right? We're a little short on our reserves. And so we need a short-term loan. Well, we adjust our loan portfolio. Maybe as loans come to due, you roll them over or whatever. But we're going to borrow for the short term to make sure we got enough at the Fed. Okay? Not that bad, right? So the Fed's fund rate is what JP Morgan charges you, the bank manager, for these overnight loans. And look, you're a profitable bank, you got lots of assets and everything. That's good. And it's overnight, and it's cash. So it's hardly anything, right? That's the Fed funds rate. Why do they call it the Fed's funds rate? Well, a lot of people get this confused because they think it's the Fed. The Fed's not doing it. Really, I mean, kind of. It's their job to manipulate that rate, but it's the rate that banks charge each other to cover the required funds that are supposed to be parked at the Fed. So to avoid all of this, that's why you just keep a little more. So in this case of the $1 million, you could keep maybe 100,000 at the Fed because that's the required reserves, RR, right? And your excess reserves, you might want to pad it a little bit and keep it, let's say, another 50 grand or 100 grand, just in case, to cover all this stuff. So you never get in the situation where it's 4:45 in the afternoon and you're calling JP Morgan for a loan. All right? So the Fed comes in a different situation. The Fed is called the lender of last resort. It's the whole purpose the Fed was created. In fact, the people that created the Fed would have hated and despised what the Fed has become, because they said, no, the Fed's going to manipulate the market, and it's going to do this, and it's going to do that, going to get involved. And we don't want it to regulate the economy. We just want it to be a lender of last resort. So if a healthy bank that's a little short on reserves needs help, and JP Morgan doesn't want to help them, and Bank of America doesn't want to help them, so on and so forth, well, then they can always go to the Fed. And the Fed will be there always. Okay? Always. And that was the only mandate the Fed had for a very long time. So study your history on this. It's interesting. All right, so let's move to the different part of the market now. So you can't borrow from the Fed funds rate. The Fed funds rate is an open market. It's the interbanking system for borrowing required reserves to the Fed. And it's bank to bank only, it's not to anybody else, and it's incredibly low right now. Now, historically, the Fed wants to deter banks from borrowing from them. Right? They want the open market to be the way to just go to another bank, borrow from them. But if it's 449, right, 459, and you're short on reserves, you can always call the Fed. We're here from you. So how do they entice banks to borrow from each other? Lend to each other, borrow from each other. How do they entice this? They charge more. Thank you, Kakos. They charge more. Okay? Okay? So you can come to the Fed, you're going to have to pay a premium. But as long as everything's good and you're healthy, they'll be there for you, and it's not a lot of money. But you're incentivized to, let's say it's 4:30 in the afternoon, you're like, man, I got a half an hour to get the cash that I need to park at the Fed, right? Just because a client came in, withdrew a bunch of money, you're like, wow, we're going to be short on our required reserves. It's 4:30. Who do you call? You call JP Morgan. You call Bank of America. You start calling all your buddies, right? And if it's you got 1 minute to go and you haven't raised the money somehow for whatever reason, you call the Fed. Now, what happens if you call the Fed and you're like, Fed, I've called everybody on my list and no one's lending me money because actually we're not a healthy bank. We're actually in a bit of financial trouble. Some of our assets have gone bust. And this is what happens now when your loan side changes. Okay? Liabilities, assets, required reserves. So let's say you got 100K here. Okay? You got 100K here. You got 1 million. Right? So this is your RRR. This is your deposits. And then your loans, you have 900K. Okay? Now what? You're the bank manager, you come to work Monday morning and find out that a $200,000 loan has defaulted. Now forget about the house and stuff. What if it was a bond? Whatever. Default. Loans go down by 700K, right? But there's a loss. 200,000. All of a sudden, things aren't balancing out very well anymore. And so you also have bank capital over here, bank capital. And what if the bank only has 100,000 in bank capital? Well, the bank loses the 100,000, so now the bank is broke. It's got zero in its net worth, and it still owes $100,000. Now what do? Yeah, no bonus for the manager. Now he's jumping out of the window. So he calls the Fed funds rate guys, loan me money, and they're like, loan you money? You have negative equity, right? You're like a Swiss franc trader at FXEM. Hey, you're negative 20 grand, but I had a stop in place. Yeah. Holy smokes. So no one wants to lend you money. Well, lend you money? You're broke. You're insolvent. So now you call the Fed and they're like, all right, we'll lend you, but now we're going to charge you 1%, and you're now going to be audited for the rest of your life, and you're going to have to walk the shame, but whatever. So that's why the Fed's there. They'll lend you to keep you alive if they have to, but then there's going to be a lot of scrutiny and so on and so forth. All right, so you got the Fed funds rate. That's the interbank rate. Fed funds rate, interbank. Okay, 0.25%. I'm getting there. I know you're getting upset with me. I know. Okay, then you have the rate that the Fed charges. Okay, and it's historically higher. Now the thing is, and I think these numbers are right. Wow. Let's do this again. Okay, so you can interbank and borrow at 0.25%. But if you need the Fed's there for you. The Fed's your friend. You can borrow it at 0.5%. Not a big deal, right? But historically, however, let's say when times are normal, let's say the Fed funds rate is 2.5%. Okay, that would be much more normal. The Fed funds rate would probably be 3.5%, right? The prime rate is probably 4.5 or 5%. Let's just do it that way. And the rate on the 10-year T-note is probably 6%. Okay. That would be much more normal. So what do you notice here in these examples between a normal market and what we have now? Look at the spread between 2.5 and 3.5 versus a quarter, right? So the Fed, so let me draw this. When the Fed was lowering, they lower the Fed funds rate, and they do that by buying and selling in the open market. That manipulates the Fed funds rate. This rate, okay, is what they call the discount rate. Okay, and this is what I'm talking about now. This is the discount rate at the discount window. Okay? It's always higher than the Fed funds rate, but usually a lot more higher. So if I can change colors here, let's say the blue squiggly line is the Fed funds rate coming down. And let's say historically this is the discount rate. And let's say it's always, you know, a certain rate higher, let's say a full percentage point. And then after the Fed lowered interest rates to like 0, one of the things they did is suddenly they lowered the discount window, and it's been much closer than it usually has. Instead of the spread now being 1%, it's a lot less. Okay? So one of the things I've been talking about for the last year or so is that one of the signs the Fed should give before raising the Fed funds rate, right? That's when they talk about raising the Fed funds rate. Well, that's just the interbank rate. And they do that through the Federal Open Market Committee that do OMOs, Open Market Committee actions, right? They buy and sell bonds. And that manipulates the money supply, and that changes interest rates, blah, 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 blah. Nonetheless, when we were talking about interest rates and the Fed raising interest rates, they're talking about the Fed funds rate. So I'm thinking, shouldn't they at least normalize the Fed funds rate and get it back to a normal spread? So instead of, you know, and I think it's 50, I can be off, but I think it's 0.5%. And, you know, this is 0 to 25, so this would be 25, whatever. So let's say the spread here is 25 basis points, and let's say they'd rather it someday be a full percentage or 100 basis points, or maybe they want it to be 50 basis points instead of 25. But they should normalize. So the discount rate should go up first before the Fed fund rate, in my opinion. Because they need to say the interbank system's healthy, the banks are lending each other money, everything's fine, the Fed doesn't need to be in crisis mode. We're not ready to raise a Fed funds rate because that's going to change things like the 10-year T-note. It's going to change things like the prime rate. It's going to change things like mortgage rates, right? Which could be prime plus a point, right? So your mortgage, let's say, would be 5.5 in a normal market, right? So on and so forth. So if they change the Fed funds rate, that's going to change these rates, and they're not ready to do that yet. But why do they need an artificially low discount rate if the interbanking system is working properly and functioning? Plus, if they raise the discount rate, if we're now talking about the balance sheet, how would that affect the economy? Well, historically, and let me clear this one more time. Let's see if you get this part. Historically, in your balance sheet, you had your deposits, you had your reserves, which are, let's say, required reserves, you had your excess reserves, and then you had loans. So let's say before the crisis, what did this look like? Right? Excess reserves were 0. And they took every penny they had and they made loans with it because they were in it for the money. Okay? Well, right now there's the reserves, so like as a percentage and stuff, reserves used to look like this. Okay, you had required reserves. How am I going to draw this now? Reserves, and it was at 10% or something, right? So you had your required reserves, and then excess reserves. I don't know if this makes sense, but I'm going to change the color here. That was fixed because that was required by law. But excess reserves went from basically 0 until we hit the crisis, and then it went wham! And they still have an unbelievable amount of excess reserves because they're worried about the financial situation. They don't want. I mean, there was a big scare when the economic crisis hit, right? So now the banks are sitting on huge amounts of reserves and they're not making loans. Okay? So loans have gone down, excess reserves have gone up. That's not a healthy economy, right? The Fed wants them to lend that out. You understand? The Fed wants to lend that out. So what can they do now? They can raise the discount window if they want, or I suppose keep it low. See, if they keep it artificially low, let me think about this here. I suppose there's no reason to hang on to the excess reserves. Because they want them to lend. So if they raise they're going to want to hold. But I guess this is just a whole different topic. which obviously we're not going to have time today. There's too many reserves in the system. But nonetheless, you have the Fed funds rate, and you have the discount rate. The Fed funds rate is what banks charge each other in the interbanking system. The discount window is what the discount rate is what the Fed charges banks. If the banks borrow from the Fed, normally the spread is wide to entice traders banks to borrow from each other and not from the Fed. Right now that spread is artificially and historically low. And I think the first step in normalization would be putting the discount rate, changing the discount rate higher, increasing the discount rate first before raising the Fed funds rate. Okay, that's the point that I'm trying to make here. The Fed should raise the discount rate before they raise the Fed funds rate, and that would give the market time to digest and prepare and understand. And right now there's just guessing and speculation, but I think that would hurt the least. All right. The only reason the Fed might not want to do it is there's too many excess reserves. So let's focus on the real estate economy. Are people borrowing money? And if so, where are the banks getting the money to lend to them? And if it's coming out of excess reserves, then that's a really good thing. So there's a quick lesson on the Fed funds rate and the discount rate. Do you have a better understanding now? I just chose to explain it from the point of view of a bank manager. So if you ever want to be a banker, I just taught you how to be a banker. It's interesting though, isn't it? It's just how banks work. You've just learned how to be a banker. Neat, huh? Yeah. Quick question. If I designed like a 3-month course on something like this, because I've been bringing this up from time to time and then people seem pretty fascinated by it. If I did like a 3-month course on banking and central banking and money supply and the value of currency, would that be something that you'd be interested in? Would you buy a textbook? Would you actually study? Would you attend a class? Would you do homework? So on and so forth. Yeah? Everyone wants to do it. Yeah, what if I charge you $1,000? And then everyone's like, oh, well, forget it. That's how it goes. Yeah, Pete's like, forget it. Yeah, oh, I want to learn, Wayne. Yeah. Pay money? Oh, forget about it. It's too much. Yeah. Yeah, well, it's just interesting. How valuable is it to you, to this knowledge? Yeah. Yeah, $1,000 textbook, yeah. Usually, I'm surprised, but anyways, well, today was free. Yeah, Pete's like not interested. Yeah, totally. Yeah, I find this stuff fascinating because you know what it does? If you understand this stuff, it translates into profitable trades. To me, it's fundamental analysis. It gets me into the trend. If you understand money, if you understand money flow, if you understand Fed policy and how it works and actually how they do it, and that you could track the money, where I could bust out a spreadsheet and say, this is what the Fed's doing, watch it. I find that interesting versus some guy that just sits down and says, oh, I think the Fed's going to raise interest rates, and then is surprised when he's wrong. Like, really? Well, you just don't, it's just, there's a lack of knowledge that, and the sad thing is that person with the lack of knowledge and no comprehension, unfortunately is in charge of $1 billion hedge fund or mutual fund or whatever they do. They don't get it. I find it fascinating because it makes trading, dare I say, easy. Well, it makes it easier. So anyways, got to go. I know it was like a 90-minute session. I apologize for that. But I hope it was worth your time. I know your time is valuable. Peace on earth. May the pips be with you. May your profits be above average. And if you learned something or at least enjoyed the discussion, leave a comment if you're watching this on the video. Thumb it up, leave a comment, ask a question. I'm here for you, babe. Just let me know you're alive, huh? See you tomorrow. Ripper. And once again, thanks for being a client of TradersWay.com.